Welcome to The Buy-In. My name is Trent Cripps, Director of Property Strategy at Sevenfold Property Group, and I'm also a long-time avid property investor myself. My co-host, Simon Podger, is Director of Lending for our sister company, Your Future Strategy. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode. Okay, today we have a very special guest with us, Gareth Croy, Managing Director of Your Future Strategy. Welcome, Gareth.
Yeah, welcome, Gareth. Howdy.
Today we're going to be talking all things scratching the surface of self-managed super funds, because we could talk for a long time about that.
Yeah.
Gareth, why would someone want a self-managed super fund?
That's a big question. So
we start big here.
Yeah. So the main reason that most people are drawn to a self-managed super fund is the ability to invest in asset classes that industry funds and retail or platform funds won't allow you to invest in. Most obvious one that people know about is real estate, residential and commercial real estate. However, there are other asset classes that SMSF unlocks as well. So collectibles, commodities like gold, collectibles like art, rare coins, those sorts of things also can be invested in. That being said, the asset classes is not the only reason that somebody might set up a self-managed super fund. Because superannuation is the most efficient way of providing for retirement benefits. And what I mean by that is, if you think about how much you need to live on passive income in retirement, the most efficient place to create that wealth is inside super, because the tax rate is concessional 15% compared to 25% for companies and individual tax rates. So the reason SMSFs work really well is because you can create your own strategy that's based on your retirement plans. So if I can contrast it between industry funds and retail, you have no control over, with industry funds, the actual underlying assets that you're buying, the timing of when they buy and sell them, and of course there's tax consequences to that. In really simple terms, if you have a superannuation fund, whether it's SMSF or not, whilst you're in accumulation phase, whilst you're working until you get to retirement age and you can access your super, you're paying the concessional rates, but once you get to retirement, they then there are no no income or capital gains taxes to be paid. So if you're planning retirement, you want some control over when assets are sold, because if you delay that until you're actually past retirement age, then there will be no tax to be paid. But if you're in an industry fund, they don't know your plans to retire. They can sell an asset, a month, a week, a year before you retire, and it's going to decrease your actual balance. So by being in control of your own superannuation, you can control that strategy and the timing of the investments. You can do that with retail or platform products, but it gives you a lot more transparency and control as the trustee as to exactly when those timings happen. The second part is you've got complete control over the actual portfolio. So diversification within it. We touched on, some asset classes that are unlocked, like collectibles and real estate, but everyone's strategy will be different as to how much exposure you should have to other asset classes. So it allows you the freedom to actually invest into, those areas with as much weighting as you want. So some people have got more comfort or appetite for higher risk asset classes, so they can control that themselves. So as a trustee, as long as it's suitable for you as a member, then it's allowed.
And sorry, can I just go back there as well? I think it's an important point that people don't realize with, especially industry funds, because I think that's probably the big thing, that people don't take it seriously enough, or look into it enough, and leave it too late in life, sort of thing. But the big industry funds, they still have the same tax rules as everyone else, sort of thing. As you said, you just don't probably see it as much. You just look at that return that comes at the end of the percentage. You don't actually see the mechanics behind the scenes, you know.
Yeah, that's right. The tax rates apply to everyone in super. So whether it's a big industry fund or a self-managed super fund, the tax rules are the same. The difference is that you've just got this ability to do a lot of tax planning inside a self-managed super fund because you're the trustee. You can control that part of the planning process and execution.
Certainly was a big question to start with, and I'm going to ask you another one. What is a self-managed super fund?
So a self-managed super fund basically is where you act as the trustee for making decisions as to how your superannuation balance is invested, how it's controlled, and how it's paid out in later life as a pension to members. So structurally, there's different ways it can be formed depending on the needs of the client or members. So it can be, you can use a company as a trustee, so what we call a corporate trustee. The benefits of that are that it becomes really clear that assets held by that company as trustee are superannuation assets, so they don't get confused with your own personal assets. However, you can also act as a trustee in your individual capacity. If you're a single member fund, so you set it up on your own, it is a requirement to have a corporate trustee, and part of that is that companies will survive you. So if you pass away, that company still exists, and so that trustee will continue. It's a big topic in itself. So what happens to a self-managed super fund if a trustee passes away, which we might cover another day.
Absolutely.
And could I just interject as well? It's interesting on the differences with the trustee as well on the lending side of things. At the start, a lot of lenders were okay with personal trustees, but that seems to have really retracted now.
Yeah.
And they're only looking at corporate trustee lending only as well. So,
and I think that the lenders are doing it based on that continuity of a corporate trustee. So if you pass, the borrower still exists.
Yeah,
and so
I was sort of thinking it more so from the compliance aspect, but it's sort of like, well, if that happens, the lender's got to be in there trying to help out. But that's a big problem if the person's pass. Whereas if you've got that entity, it's a lot easier to do the administration of that. So
yeah, absolutely.
You touched on a single member fund. Typically, how many members can a self-managed super fund have, and what is their role?
So maximum 6 members, and as I said, minimum 1. So the role, if you are a member of a self-managed super fund, you also have to be trustee. So unlike industry funds where you're a member, but of course you're not the trustee, you're not in control of the superannuation fund. So you have to be in both capacity as member and trustee. There's some exceptions to that. So if you are a minor, your guardian can act as trustee for you. But again, technically for most people who are probably listening will be over 18. And in that capacity, they need to be both member and trustee.
Wow. Obviously, with a self-managed super fund, the name self-managed is probably a bit misleading because it's probably not the easiest thing for somebody that hasn't, got advice. But, in terms of the roles and responsibilities of the trustee versus, say, a professional advisor like yourself, how would you recommend somebody starts that process of engagement?
Yeah, so it's important you understand the obligations imposed on a trustee. So what is required of you? One of the big ones is to have an investment strategy for the superannuation fund, and that needs to tie back to a strategy that's appropriate for the members, which it's an odd sort of thing because you are the trustee and the member, but you really need to think of yourself in 2 capacities. So when you're making decisions as a trustee, if it's got multiple members, it's not simply what you want to do, but it's what's right for all of the members. And so there are obligations, there are responsibilities. In the same way, if you're a director of a company, you've got obligations under the Corporations Act. trustees of self-managed super funds or any super fund actually have obligation to members. So things that fall into that they need to consider are the investments appropriate for the members? And so that's where we look at what's the age of the client, how much runway have they got through to retirement. So we haven't got highly volatile assets when you're imminently looking to retire and at risk of capital loss. Also considering the comfort levels of risk for a client. In the same way, if you've got an industry fund and you tick, I want a balanced portfolio as opposed to growth or high growth, is based on looking at your fund balance and how comfortable you are with the volatility or change in it as appropriate to the member. We're also looking at things like liquidity, so making sure that the fund has got enough cash to meet its obligations. So if you do buy a property, there's enough money to cover mortgage repayments, insurance premiums, any professional advice or fees, etc. So liquidity of the fund. And then we also have an obligation to think about insurance for the members as well. So the legislation doesn't say you have to have it. It just says that you have to consider, and it's always good to document why you've made that decision. And in some cases, we don't need it because we've got adequate funding or adequate resources elsewhere. In some cases, you've already gone into retirement, so you're already self-funded. Or it might be simply that, whilst you can see that the member might need it, it's just not attainable because they already have a pre-existing medical condition or something else. So the investment strategy is a big piece of consideration as the trustee for the fund and how it relates to what is needed for the members.
I think one thing we touched on earlier was that you've got to remember that once it's all open and stuff like that, it's just like a normal bank account essentially. So you do have to have that discipline and your advisors and stuff like that, because you hear about like non-compliance and things like this sort of thing because they're doing the wrong thing against the fund. And you've I think you touched on as well, is that you've got to think of it as a totally different entity, even though this names are all the same and self and all this sort of stuff is all in there. Yeah, that this is a totally different vehicle to generate wealth, sort of thing. You've always got to keep that in the back of your mind. I
think a good way to picture it is that the member is your future self. It's you once you hit retirement age. And so your trustee hat on is, I'm making decisions today for my future self rather than your position as you are right now. And so then you'll be in a better position to make the right decisions in line with the whole purpose of superannuation. There is an overarching principle called the sole purpose test, which basically says when you're making decisions, they need to be for the provision of retirement benefits for the members. So that is where it ties into not just a lump sum that's providing an ongoing cash payment or a pension, as we call it. It's also about those insurances, which falls into a retirement benefit. So the whole purpose then is understanding, is the decision going to positively affect you when you're in retirement to meet that sole purpose test.
And coming back to the members of the fund as well, I'm not sure if we touched on it, but you don't have to be in the same family or anything like that sort of thing. There's sort of arrangement where you can sort of be, I don't know what the technical term is here, sort of thing, but business partners, I'm thinking, or something of that nature.
So business partners can be both members of a self-managed super fund, and that works particularly well if there's property that you're looking to acquire or for your business, so you can lease the premises from that self-managed super fund. There is a restriction that says that an employee and an employer can't be in the same self-managed super fund. So if and also a related party. So if I'm a sole, moving into a self-managed super fund, and my wife, her employer, and I couldn't be in the same self-managed super fund together. So there is a restriction around that. However, family members together is very common, and it's actually not a bad sort of thing as a multi-generational thing to use, where you've got a mum and a dad and some children, as long as it doesn't exceed the 6 members, you can work and talk together about what the investment decisions are and use that as a educational platform to be talking as a family about what investing and what's suitable and how that works for the individual members.
And then just coming back to having those 6 members sort of thing at different stages of life. I'm assuming then that comes back to the investments. You're able to allocate them to make sure when that person's closer to retirement versus the person younger, that still caters for everyone, I suppose what I'm trying to say.
Yeah, so there's this really interesting concept around whether you co-invest or whether you segregate the assets. The important thing is that if you've got members who are moving into pension phase, that, as I touched on earlier, this liquidity element of going not only mortgage repayments, etc., but you've got to think about making these cash payments for pension payments to that member. So you can still co-invest as long as that liquidity is considered. What is quite common is that you can go down this strategic track of segregating assets to say, look, these particular assets are held for that member, for their member balance, someone else for a different member balance. And the strategy around that allows you to utilize these differences in tax treatment between accumulation and pension. So as I mentioned earlier, if you're in pension phase, you won't pay tax on capital gains or income tax. So if you've got an asset, growth asset, think of things like shares and property, you've had a really nice capital growth through that. If that asset is allocated to the member who's in retirement phase, they can sell that asset without incurring any tax. So it's strategic. And every year those assets can be moved between different segregated portfolios.
I was going to ask you this question a little bit later, but now that we're focused on members, once your fund is set up, can you add members post the fund setup? And also, can you remove members if something happens, i.e. like a relationship breakdown? And how is that separation happens?
Yeah, so let's deal with the application first. Or adding members is an application that somebody makes to the trustees of the super fund. They can reject it. So they can say, actually...
So you make it sound like some exclusive club that you have to apply,
Yeah, well, it's always good to grease the wheels. But no, the existing trustees can reject it for various reasons. But generally speaking, that's something you've had a conversation with beforehand. So, but you should document that as a formal written application and then minute that as the trustees that you've considered and you've accepted it. There are other obligations on the person coming in. So as I said, if you're a member, you need to be a trustee. So you then need to be added as a director to the corporate trustee, if that's the structure you have, or as a trustee in your own right, if that's the structure you've got. There are obligations then of providing documentation to the ATO to say that you consent and you understand your obligations of being a trustee. So there's a process, but yes, you can add trustees and members. Likewise, you can remove them. So if it and it doesn't need to be a family breakdown, but family law often, if there's a divorce, you can do one or two things. One member can leave and we can roll out assets. You can't, obviously if you leave, we need to roll over your member balance. So that can be done as an in-specie transfer. So the assets that you have can be transferred, or you can do that with cash, sell assets and transfer it as cash, leaving the other members and trustees behind. So there is a process. I guess in line with that also, you can wind up a self-managed super fund if you get into it and you decide it's not for you. Or what is common is they are used as really good vehicles for accumulating wealth because of things like property and control of your strategy with equities. But then once you retire, you're looking for something particularly passive, you can sell down your portfolio, transfer it back to an industry fund where there's not as much process, there's not as much responsibility, etc. as well.
Interesting. With two members in the fund, if they're bringing, I guess, different levels of investment into the fund, how is that treated?
Yeah, so there's no minimum to get in. So we've got limits on not so much how much you can have in there, but it's how it's taxed, depending on how much you have in there. But the key thing is that at all times, every member has their member balance accounted for. So your money rolls in. There are certain costs that are attributed directly to your member balance, such as insurance premiums. If you've co-invested, the earnings from those, or the growth from those investments, gets allocated pro rata. So you've at all times got a split as to who's got what within the super fund. So it doesn't sort of roll in and just become one big fund. It is very clear as to how much of the balance is split between members.
Okay, so let's go back a couple of steps now. What really we should, when we've made a decision that we want to proceed with a self-managed super fund, after talking with somebody like yourself, what's involved in the setup of a self-managed super fund?
Yeah, so once the decision's been made around how you want it structured, there are obviously entities to be registered. If you're going down the corporate trustee track, there's a trust deed that needs to be prepared and executed. And I can come back to the trust deed. It's a very important instrument because it actually tells you what the super fund can and can't do. And it can be amended and varied, and it's a living, breathing document trustees work from. So the process of registration, establishment, you're then required to apply for an ABN for the self-managed super fund and a tax file number. That notifies the ATO that you are intending on being a registered complying superannuation fund. They do their own checks to see that you are an appropriate person, so you're not a disqualified person. You are able to act as a trustee. And then once they issue that ABN, that then allows you to set up some practical things like bank accounts, etc., so that you've got somewhere to be able to roll over your superannuation funds into, etc., and start investing, and somewhere for your premiums to come out for insurance. The process can take, the application process for the ATO can take up to 28 days for them to process that application. And in certain circumstances where they want to make further investigations, that can take longer than that. In some cases, the ATO will simply issue the ABN and the tax file number, and at that stage, once your compliance status is published, then the trustees of other funds, so retail and industry funds, are then able to do a rollover of your existing balance.
And what happens to those funds at that point in time? Do you wrap them up, or?
You don't have to. You could have multiple accounts. In some circumstances, having your existing industry fund, perhaps that you've had for a while, might have some insurance attached, and on inspection or on inquiry, you're unable to obtain insurance as good as or better than what you currently have. And in those circumstances, it might be appropriate to maintain a minimum balance so that you continue with the insurance policy, and so you don't lose that. So you wouldn't do a full rollover, you do a partial rollover to maintain that policy, and continue to review that. At some point, as I mentioned earlier, it may not be appropriate. You may not need insurance anymore, and at that stage, for simplicity, administration, saving on some admin fees, you just roll over that balance and close out your industry fund.
And just leading into it, you hear a few misconceptions and stuff like that, but just talking about fees, people say, oh, if you have an SMSF, the fees are so expensive and stuff like that sort of thing. But I don't think some people realize what goes into it, and the compliance and the complexity and stuff like that. But obviously it is something that people need to consider as well. Sort of.
I also don't think they understand what fees they're paying with their industry and
That's
retail super funds.
Yeah, so it comes back, they just, set and forget, who knows where it goes, and they never take a look at it. But then when they look at somewhere else, they don't. Yeah, it's a good point.
Yeah, and I think the fee thing's a really interesting one for people as they accumulate this wealth that is nearing or certainly towards the middle to latter end of your working career. You should be amassing a reasonable amount of capital or equity within your super. And at that point, particularly with industry funds, they typically have a variable fee. So the more you have in super, the higher your fees are. Whereas with self-managed super funds, typically they will be fixed fees. So whether you've got $300, $500, $1 million, you still need to have a set of financial statements, an audit report, and a tax return completed and lodged. That cost doesn't really change. So ironically, later in life, it can actually be cheaper than industry funds because you've got this fixed fee environment, which ends up being less than the variable fees that you pay.
So what you're saying is, once your balance gets to this tipping point, you can pretty much do exactly what your retail fund is doing, in terms of investments and stuff like that. Just mirror it, but then your fee structure's fixed essentially, and probably a lot lower than what that is on the percentage basis or something.
Yeah, correct. It's important though as well that if you seek advice from a financial advisor, they have an obligation to look at whether a self-managed super fund is suitable for you, and will look at whether and make a statement that it actually puts you in a better position. So I guess the point for that is, even though the fees might be more transparent and seem more expensive than what you're currently paying, depending on the strategy you're looking at, if you look at the net result after fees, if the financial advisor has to satisfy themselves that is actually appropriate, but also puts you in a better position. If they can't, then they can't give you the advice or shouldn't be recommending you proceed.
Yeah, and I think to Trent's point, it's like, well, it's never really presented as clearly as that, or people don't take note as much as they probably should getting their annual retail fund and stuff like that. So
I think, the observation is that if there's a barbecue story about, I've got a self-managed super fund, and you want a cookie cut and go and see someone to set it up, you run the risk of not setting it up and having a strategy appropriate for you. No two self-managed super funds should look the same. And so if you are getting that generic advice, then there is a concern that it's not appropriate, and it may not be actually maximizing the right outcomes for you. And so depending on your stage of life, your comfort level, just a whole bunch of variables that will change the advice. So, your neighbor, your friend, your cousin, what advice is right for them won't necessarily be right for you. So yeah, we do hear a lot of people going, I want to set up a self-managed super fund to buy an investment property because that's what someone else did and I saw that was successful. That's a great reason to inquire and investigate it. Yeah. But it really comes back to what is the strategy, and then once you understand that, then you can evaluate whether it's right for you or not.
Gareth, you touched on before the audit. With your self-managed super fund, once it's set up, the ongoing tax process associated with a self-managed super fund, is that very different to doing your personal tax returns?
Yeah, they're separate. So, what you do with your individual personal tax returns or company tax returns is completely separate. So you also have to lodge a tax return for the self-managed super fund. It is a separate legal entity. The important thing about the audit is it's basically the ATO's way of supervising the industry. So the other types of super, they all have a prudential regulator called APRA. They are the ones who make sure that they are following the rules, whereas with self-managed super fund, it's actually regulated by the ATO. And the way that they ensure that trustees are conforming to legislation is by getting an annual audit done, and that audit report gets filed with the tax return with the ATO.
Well, that's a fantastic introduction to the world of self-managed super funds. Thank you very much, Gareth, for that. It was a great informative session.
Yeah, 100%. Thanks, Gareth.
No problem.
We'll definitely have you back to get more details around asset classes and so forth in investments inside the self-managed super fund. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode.